Hi, this is Jeff Hansen, the developer of Focus 15 Investing. This is part 2 of a 3-part series on performance expectations. This part covers the objectives and benchmarks that we use in evaluating the Focus 15 investing portfolios. The 3 parts of this series are the tyranny of low volatility investing, the objectives and various benchmarks, and the final part is known biases in the performance patterns of the model portfolios. And this is the second part, objectives and various benchmarks. For most Focus 15 model portfolios, the objectives are to avoid major losses and to participate in strong stock markets. And finally, to get a favorable return for the level of variability or volatility that one must tolerate to get those higher returns. The key comparative benchmarks that we show in the Focus 15 publications are the ETFs in the model portfolios held at constant weights over time, and I've referred to that in other videos as the upper risk mix. The second comparative benchmark is what you would be doing if you weren't using Focus 15 investing research. This is a little bit harder for us to evaluate, but we're using a proxy for what most investors might do if they are using a standard asset allocation that's stable over time. The third comparative benchmark is the stock market in general. And for this, we use the Dow Jones Industrial Average because it has a long history and it's an important index for our investment strategy. So let's look more specifically at the upper risk mix that is shown in the publications. And this mix consists of the same ETFs that are in the model portfolio, but the weightings are stable over time and they're very aggressive weightings. They have high allocations to stocks, and this gives us a sense of the aggressiveness of the ETFs being used. This is a challenging benchmark, and over some periods of time, the model portfolios can be expected to underperform this aggressive mix. So when the stock market is moving higher, the model portfolios representing the trades may underperform this mix. But this mix gives a good indication of the long-term performance because it indicates the level of risk that's being taken in the model portfolio. So in some ways, it's a conservative or a very challenging performance benchmark that underscores the risks being taken. The upper risk mix is shown in the publications off to the right. This is a screenshot of one of the model portfolios, and it shows the current target weights. It represents the asset allocation decisions and the ETF rotation decisions that come from the Focus 15 research, and it shows the upper risk mix, and that upper risk mix represents the same ETFs that are held in the model portfolio but held at constant weights over time. And in this case, the upper risk mix indicates 70% of the portfolio's assets are held in the ETF DDM. Right now, the current target weight shows a 0% allocation to this stock-related ETF. The upper risk mix is shown as the tan line, and we can see in this early time period beginning in 1996 that the traded portfolio, the model portfolio, actually underperforms that upper risk mix during the early part of the period. But when the stock market and the upper risk mix start to decline beginning in 2000 going down to 2003, the traded portfolio moves higher. And clearly the model portfolio is superior. It's a better return and better loss avoidance than the upper risk mix. Looking at the upper risk mix over a shorter period of time, we see the model portfolio outperforming the upper risk mix and then keeping pace with the upper risk mix when the market moves higher. And then during the period of volatility, the model portfolio avoids some of the losses of the upper risk mix. The second comparative benchmark that we show on the Focus 15 investing newsletters is intended to be a proxy for what investors might do, what subscribers might be doing if they weren't doing Focus 15 investing. And a common asset allocation for many investment products is to hold 60% in stocks and 40% in bonds. The Vanguard Balanced Index Fund, VBINX, has that stable allocation of 60% stocks and 40% bonds. So we show that on many of our reports as a comparative benchmark. And if we include that on the chart that shows the recent performance, again, the blue line is the model portfolio, the tan line is the upper risk mix, and the lighter blue line represents the performance of VBINX, the Vanguard 60/40 mutual fund. Now, it's clear that the traded portfolio does reasonably well during the strong upward trending market from the period of 2014 to April of 2019, and it outperforms the upper risk mix, but it outperforms the alternative for many investors, a fund like VBINX, by even a greater margin. So that's the second comparative benchmark, something that represents a reasonable alternative to the Focus 15 investing model portfolios. A key metric that we look at, particularly over mid to longer periods of time, is the ratio of return to variability. This table shows the rate of return on an annualized basis for these different investments. The model portfolio has an annualized return of 11.9%. The upper risk mix has a return that's just slightly less, 11.4% on an annualized basis. The Vanguard Mutual Fund, VBINX, has a return of 7.1. The variability, which is the standard deviation of weekly returns on an annual basis for the model portfolio, is 9.5, and it's quite a bit less than the upper risk mix of 13.3%. The Vanguard Mutual Fund has a variability that's lower than the others at 7.8. If we calculate a ratio of these two numbers, this ratio becomes a very useful metric to compare the attractiveness of these different return series. The ratio of return to variability for the model portfolio is 1.25. For the upper risk mix, it is 0.86. And for the Vanguard Mutual Fund, it's 0.91. And so from this perspective, the Focus 15 model portfolio has higher return for the amount of variability that one must endure to get that return. Over a long term, 3 or 4 years or more, we want to have this value, this ratio of return to variability, to be 0.3 greater than these other reference portfolios. This is a key statistic. We want to have this ratio of return to variability to be higher than the corresponding ratios for the upper risk mix and for the alternative investment product. And in this case, it is clearly higher. If we put those comparative benchmarks on this longer term chart that begins in the year 2000, we see the upper risk mix as the tan line, and it moves higher and lower more dramatically than some of the other series. The VBINX is this turquoise line, and it's more conservative and doesn't move as high as the upper risk mix in this later period. The model portfolio, which represents the ETF rotation strategy, performs better than both those comparative benchmarks, the upper risk mix and VBINX, over this long time horizon. The third comparative benchmark is just simply the Dow Jones Industrial Average. This is attractive to us because it has a long history, it's an important investment in many model portfolios, and it's good for longer term risk comparisons. This is a risk and return chart that appears at the top of many publications. The vertical axis is the expected return, and the expected return in this case is simply the return of the simulation since January of 2000. The horizontal axis is the expected variability, and variability is the standard deviation of weekly returns on an annualized basis. Both of these numbers are annualized, and this area, the upper left-hand quadrant of this chart, is attractive. It has high return and low variability. That's a good thing, and that's indicated by this label better. The opposite quadrant is high variability and lower return, and so this is worse. The fund VBINX is shown in this spot, and it has a return of about 6% annualized since 2000, and the variability is just about 10%. The Dow Jones Industrial Average has a variability of about 17% and return a little bit higher than VBINX of about 7%. The model portfolios have performed well in simulation over this time period. The Quartz model portfolio has the highest return at about 14% and a variability of 9.1%. And so these two reference portfolios, VBINX and the Dow Jones Industrial Average, give you a good idea of the amount of variability and return that we're getting from the Focus 15 investing model portfolios. If we put together the three comparative benchmarks, the upper risk mix, VBINX, which represents the type of investment that many people will have, and the Dow Jones Industrial Average, we get an idea of how the model portfolio performs. These lines moving across the bottom are those three comparative benchmarks. VBINX is the turquoise line, the Dow Jones Industrial Average is the dark green line, the upper risk mix is the tan line.